On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and joining me today is Thomas Martin. He is the partner and senior portfolio manager at Globalt, and he is joining me from Atlanta, Georgia today. Thomas, welcome back to the program. So much to talk about. Issue number one is clearly the war. It's a disruptor for traders and for investors. Let's say there is further disruption in the Strait of Hormuz. What do you think? Which domino is going to fall first? Is it going to be oil or is it going to be the stock market?
Well, the stock market tends to react very quickly, but so do the oil markets. And the stock market is going to take its cue from what happens in the oil markets, but more importantly, what they think is going to happen, going forward. It's all about, how does this get resolved and how long does it take? So, whatever news we get, and we're looks like we're headed for a bit of a showdown here potentially at 8 o'clock tomorrow night. And depending on how that plays out, it could, be positive for the markets if there's some sort of a deal or a postponement because, negotiations are actually considered to be serious. Or there could be an action which is, could go all the way up to being pretty significant. So a wide range of potential outcomes, which is why right at the moment you're seeing the market react almost like nothing. I mean, it's like, what are you going to do? You're neutral.
Yeah, well, and this president has given deadlines in the past, and he really he'll make a move prior to the deadline. So the Iranians should probably do something sooner than wait until tomorrow night and to see what happens. But the question I would have is, what exactly are we going to be able to do? We've hit 11,000 targets, so you have to wonder. That's a head scratcher of what's going to be expected. But who knows what? I mean, I guess we'll have to wait and see what happens. But my question for you though is there a price per barrel of oil that you feel that is going to be the trigger that's going to push the U.S. economy into a recession?
Well, I mean, I'm sure there is one, and it's probably in the 150 to $200 range. But more importantly, it is just that the high price works its way through the system, and it's already working its way. It's not just the price of oil, but it's the disruption and the flow of all the things that go through the strait, which is not just oil. It's petrochemicals, it's critical minerals, etc. So many things, and you're already seeing the reaction in Australia, in Japan, in European markets with rationing and lower usage and preparing for shortages, etc. And gas prices in the United States are already close to $4. And you see that going through in technology areas. I mean, it could affect the AI infrastructure trade in the sense that these things do go into the making of optical equipment, et cetera. And so it's not just the price of oil, but it's all of these things coming together over a period of time that isn't easily get back on trackable. So just as an example, when you had the tariffs, you could put a tariff on, you could put a tariff off. And, it was almost like, spitting out your gum once you had, had a piece of gum in your mouth. That's not going to be quite so easy to do in this situation. And particularly when you're destroying things with bombs, and
Yeah.
especially if it's like infrastructure.
Yeah, no question about that. I'm a bit surprised though, and just to turn the page here, I am a bit surprised. We could talk about the jobs report that came out on Friday, and I know that the Iran war, higher oil, all of this pertains to what the Fed is going to do when they meet August 28th and 29th. But that jobs report on Friday got very little press today. I was very surprised. With that print of being plus 178,000 new jobs created in the month of March, what kind of hand does that play for the Fed at that next meeting?
Right. Well, there were puts and takes associated with that 178 number. Some other numbers were lowered, and there were some mitigating factors. But it was a strong number, but the wage increase was lower than expected. And so the question is, who has the upper hand? Is it labor or is it, the people who are hiring the labor? And I don't think that that point was really solved in any sort of a way. But the U.S. economy has started from a higher place, from a very strong place, and it's still in a strong place. So it's going to take, we've got some cushion before you sort of knock that out. With regard to the Fed and what they can and can't do, with regard to oil prices in specific, they've already said we can't, what we do doesn't help or influence a supply shock. So they've already said that there's not much they can do. And if that is the mechanism of inflation, then what you're really worried about is a growth scare. And if growth slows down, ultimately inflation, broadly speaking, not just the price of oil, would come down, and the Fed would theoretically be more likely to need to lower interest rates to stimulate the economy, even if there was inflation from oil in the system. So it's complicated, and the Fed's going to have to be very careful here, and their default is going to be to stand pat.
Right, right. I wanted to ask you this. I know you were on a competing network this morning, and you have been very public about emphasizing treasuries over credit. What concerns do you have right now regarding the current situation with the credit markets?
Well, if you just look at credit in general and not, specifically going to high yield or private credit or the issues associated with that, you want to be compensated for the extra risk that you are taking. And there is extra risk, not that we've seen much of it lately. In just the garden variety credit markets, but the spread has been narrow, and in order for it to be attractive and to be compensated, it needs to blow out a good bit. I mean, even just to get back to some sort of more average type level, let alone blowing out to levels that are truly attractive. So we just don't see that happening right now. And the cracks that are happening with private credit, we would say, although it's concerning, we would think that Jamie Dimon pretty much had it right in his letter, which is that it's not systemic at this point. It's more idiosyncratic and associated with the funds and liquidity itself. So, one thing we like is treasuries because it's the biggest market in the world and it's liquid. You can get your money without moving the price. And in difficult times, that's what you want. You want big liquid things that you can move around in.
Yeah, no, that's terrific advice, actually. So let's talk about sectors then. Do you think this is a market right now that actually rewards defense? I mean, are there any sectors out there right now that you could still be aggressive with that you think that you'll be able to get through this geopolitical crisis?
Well, and there will have been in hindsight when we get through it. But in the meantime, I think this is really not a time to be making bets. There aren't any big, fat softball pitches that you can look at. So either things are, genuinely in trouble. Just take, for example, on the AI trade, you have software and software that can be disintermediated by AI. And that's proving to be a real thing and to be sustainable on the downside for many types of software companies. So they're cheaper, but they're not super cheap, and you don't necessarily want to get in front of that. On the other hand, the places that are clearly attractive, and as we saw with the OpenAI and Anthropic IPO information that we got, they're spending still very, very strongly. And so, you still need memory and disk drives and microchips, et cetera. And so those are very attractive, but those have been bid up a good bit. They're being bid up today. But they also have corrected a little bit, but they have room to fall. So there's risks everywhere with strong fundamentals or poor fundamentals and the valuation associated with it. And in that type of an environment, it makes sense to have very careful, limited exposures to what you think is sort of the best in each of those areas.
Thomas, what do you think is the biggest risk to markets over the next 90 days?
Well, clearly it's the war, and it's the resolution of that. That is the thing, and why the markets are hesitant right now, and why they have reacted in the past. And we would also suggest that, coming into the war, coming into February 28th, when this really didn't even seem like it was going to be a thing, a real thing, that markets were positioned somewhat aggressively for a good year. The expectation was for the S&P 500 to be up 10% or so, and for the AI trade to probably work, even though there were questions about it, et cetera. And now you have the markets that have, you had some bigger moves in relationship to some of the things that were said about the war. And some pretty big days, both up and down, as the market adjusted, investors adjusted their positioning to get to a more neutral-ish type position, which is what I just was talking about. So that's why it's a big risk. And it's still not priced in, really. Like the dire situation is not priced into the market because oil's at 110. It's not at 150 like we talked about, or 200. The S&P 500 is a mere 5% off of its high. It's been a little bit lower than that, but nothing even, approaching basically a normal garden variety correction. Treasuries at 4.3 on the 10-year are in the middle of the 4 to 4.5% range. VIX is in the low 20s, down from 30. So you're not seeing anything dire. So there is room to the downside. And yet you see that investors still want to believe that they want to be there in case the markets do come back, and the world is a safer place, and growth continues to come through.
So, with all those things that you just said, which are really, I mean, positive. So, let's say, hypothetically speaking, the war ends today. We have a ceasefire deal. The supply chain in the strait gets back to normal. Would you be cautious or would you be bullish or bearish going into equities this summer?
Well, my guess is that the way markets will react is that they will go back to the leadership that they had prior to this. And although that leadership is growth, it's large cap growth, it's technology, it's the winners of these kinds of trades. It may not be the Mag 7 per se, but it might be portions of the Mag 7, et cetera. And so the market will come back to wanting to be overweight those areas. This was the trade that took us, through 2025 up until November, until it started to be called into question. But I think if you get an all clear, and you go back to the, even better than it was before, because now the world's a safer place. Oil will go back to some level that is reflective of that growth, and it's not $50 a barrel, but it's certainly a good bit lower than 110 where we are now. And the growth sector, which has underperformed value for a good bit here, as value is used to protect, we'll come back to those companies. And I think that's where we and a lot of market participants are going to want to be.
Yeah, I completely agree with that statement. Absolutely accurate, and I can see all of that coming true. Thomas, we're going to leave it there. This was fantastic. I know we'll talk again, definitely into the summer. It's great to talk about summer now. I know we're into April. However, there's snow expected in New York this week, so call me crazy, but I don't know what's happening there. But I do appreciate you joining me on the show today, and I can't wait to have you back.
Great. Thanks for having me on, Todd. Always a pleasure.
Absolutely. So on behalf of Thomas Martin, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. Coming up at 3 o'clock at the top of the hour, live, Joe Madden is going to break down the national championship tonight between Michigan and UConn. You will not want to miss Madden on the Line. Live, 3 o'clock today. Until then, take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.
We're the economic modern family. Watch the flow. Market vibes tell you where the trends might go. We're the economic fam, guiding the scene from the streets to the screens to your trading machine. Tap in, stay tuned, feel the beat line, cause the market tells a story through the family line.
There's more happening behind the headlines, and you deserve the full story. At Biz Talk Today TV, we break down investing, government moves, entertainment business, and even sports gambling, all in one place. Real conversations, smart insights, content that helps you think smarter and stay ahead. Thousands are tuning in. Don't miss what's next. Subscribe now to Biz Talk Today TV on YouTube and join the conversation shaping the future.